All right, let's break down the absolutely wild earnings report from Vince Holding Corp. As analysts here at Talk Tickers, we see a lot of reports, but this one was different. On September 10th, the company dropped its Q2 results, and it set off some serious fireworks in the market. So let's jump right in. Yeah, you're seeing that right. The very next day, the stock just took off like a rocket, closing up over 82%. And get this, at one point during the day, it was up over 110%. A move that massive, well, it makes you ask a really simple question. How on earth does a company's stock go to the moon when its sales actually fell? On the surface, that makes absolutely no sense. It's a total head scratcher. But the answer isn't in what they sold, it's all about how much they made on what they sold. The real story is buried a little deeper. And here it is, the big disconnect. Look, revenue was basically flat, nothing to write home about, though it did just squeak past estimates. But the earnings per share? Whoa, Wall Street was expecting an 8-cent loss. Instead, Vince delivered a 38-cent profit. That's not just a beat, that's a 46-cent demolition of expectations. So right away, you know this story has nothing to do with growth and everything to do with pure profitability. And, it wasn't just Wall Street that was caught off guard. The CEO himself, Brendan Hoffman, said it on the call. The profitability was way beyond what even they were guiding for. That just confirms it. This was a genuine operational surprise, driven entirely by their ability to squeeze every last drop of profit from each dollar of sales. So the big question is, how did they do it? How did they pull this rabbit out of the hat? Well, to understand that, we've got to pop the hood and look inside the company's profitability engine. It all starts with a very clever shift in their business. And this right here tells you so much of the story. They have two main ways of selling clothes. The high profit way, which is their direct-to-consumer business, their own stores and website, that grew by a really healthy 5.5%. At the same time, their lower profit wholesale business, selling to big department stores, actually shrank. So think about it. They're trading low margin sales for high margin sales. That is a fantastic recipe for a healthier bottom line. And here's the beautiful result of that strategy and just some incredible execution. Their gross margin jumped by 300 basis points. That's a massive 3% leap in just 1 year, pushing them over that magical 50% mark. Now, for a retailer, getting over 50% gross margin is a huge deal. It's a signal of a really strong brand and some serious pricing power. So this wasn't just one thing. The team was firing on all cylinders. They got their product costs down, they were smart about raising prices, and crucially, they didn't have to put everything on sale. And here's the kicker. They actually got a bit lucky. Shipping delays from tariffs meant they had to keep their spring collection on the shelves at full price for longer. A happy accident that padded the bottom line. Okay, so amazing quarter, incredible execution, stock is soaring, everyone's happy, right? Well, not so fast, because then management got on the conference call and poured a little bit of cold water on the party. This is their guidance for the next quarter, and it's pretty underwhelming compared to what they just did. They're guiding sales to be flat to up maybe 3%. And just look at those margins, way, way down from the 50% they just hit. So you have to ask, why this sudden caution after such a monster quarter? Well, here's reason number one, tariffs. Management put a number on it. They're expecting a $4 to $5 million hit in the second half of the year. Now, they think they can offset about half of that by changing up their sourcing and pricing, but still, that's a big new cost they have to absorb. And this quote just says it all. I love that phrase, confidently cautious. They know they did well, but they're not getting carried away. And here's the other part of the puzzle for that lower margin guidance. They're going to take some of those extra profits and reinvest in the business. Basically, that means spending money now on things like marketing to grow later. That's a good long-term move, but it definitely puts a dent in short-term profits. So there you have it, a spectacular quarter in the rearview mirror, but a really murky and cautious road ahead. This creates a classic Wall Street battleground for the stock. So let's break down the bull case versus the bear case. The bull case is pretty straightforward. You're betting that management proved they can execute at an elite level. Their direct-to-consumer business is strong, and their margin discipline is for real. The bears, on the other hand, are going to point right to that weak guidance, the tariff problems, and the fact that spending more money is going to squeeze those beautiful margins. So the whole debate really boils down to just one thing. Was this amazing profitability a one-time fluke, or is it the new normal?
So, what do we think is going to happen on the next earnings call? Well, our prediction is that they'll probably hit the high end of that pretty low revenue guidance. But the real story, again, is going to be another beat on the profit line. This management team seems to like to underpromise and overdeliver. As for the stock, it's going to be a bumpy ride for sure. But after a huge move like this, a new higher floor has been set. The market is now looking at this company in a whole new light. So when we put it all together, our official rating here at Talk Tickers is outperform. We think the market is right to reward this kind of operational excellence. We believe these profitability improvements are more sustainable than their cautious guidance lets on. Plain and simple, this team has proven they can navigate a really tough environment, and we're betting they're going to do it again.
This is not financial advice.